Hello, hello, and happy Thursday. My name is Maggie Nielsen, and I am here with Purse Strings. Purse Strings has been coming into this group for a couple weeks now, and we are all about providing some financial education, tips, tricks, know-how. But then when you're ready to go put things in transition or transaction, either you're getting divorced, you're selling a home, you're getting married, you're planning for retirement, you're planning for kids going to college. We have financial professionals ready, willing, and able to help you. We call those our Purse Strings approved professionals, and Jamie Minster is one of them. So we're so excited to have Jamie on today talking about selling a home during a divorce. But before we dive into all that fun, Jamie, could you give us a little intro of who you are and what you do?
Absolutely. So I'm Jamie Minster, and I am a CDFA, so I'm a certified divorce financial analyst. I was a financial advisor for many years, and then almost 4 years ago, I made the transition into mortgage. So I bring a lot of financial knowledge to the mortgage business, as well as all of the divorce planning pieces as well.
Awesome. Well, we're excited to have you on today. And be part of this conversation. And anyone tuning in, if you do have questions, feel free to put them in the chat. If you are watching the replay, we'll work to get those questions answered as well. So yeah, let's dive into this. So kind of where we want to start is, why would you want to speak with a divorce mortgage professional before finalizing your divorce agreement?
So that's a really great question. So what I find is that there isn't always a lot of cohesiveness between the attorney team and the financial parts. So attorneys draft these agreements that everyone is agreeing to, but they don't always take into consideration how mortgage rules impact the ability to purchase or refinance. So there are small things that you can do in your agreement that have huge impacts on your ability to refinance or qualify for a mortgage. So what I like to say is, just because your divorce decree says that you can refinance the house doesn't mean that a lender is going to lend you the money to do so. So it's really important that you get qualified prior to signing everything, because sometimes we can change just a little bit of language, or we can reallocate debts or assets, and that allows you to qualify and to do the things that you wanted to do, that you want to honor your agreement.
Interesting. Yeah. We always say, there's so many people in a divorce because everyone has their lane. The attorneys know the legal stuff, but they don't always know all the mortgage stuff and how that lines up. So you got to get everybody really on the same page.
Well, and the other thing to keep in mind too is, statistically, there are 18 rule changes a day in the mortgage world. So what was true? Yeah, and most of them are just tiny little tweaks, or they're small pieces. But so what was true yesterday or a year ago or 6 months ago just may not be the case anymore.
Wow, that's great to know, especially if you're just buying a house in general. You got to keep up a little bit.
Yes.
So I know this group that we're talking to is our empty nester. So if you're an empty nester, you're probably thinking about retirement or maybe even retired. So if people are getting a divorce and, are retired or thinking about, going to retire soon, can they qualify for a mortgage?
Yes. Actually, there's a number of ways that you can still qualify. We can use your Social Security benefits. We can use support that you're receiving. Oftentimes we can also use assets as income. So depending on how your finances are structured, being retired does not mean that you cannot qualify for a mortgage. So that is often a surprise for people. Well, I'm not earning income anymore. Well, you're still receiving income of some kind, to pay for your living expenses.
Right. Yeah. So yeah, that makes sense that you can still qualify and get a house. You just don't have to be a renter or something from here on out.
Yes. And we are seeing a lot more what is qualified as gray divorce, meaning people that are, retired right after retirement, that maybe have said, I still have 20 or 30 years. Maybe I want to do something different. And so there's a little bit more pieces in that as well, that you maybe don't have time to recover from making poor decisions in divorce. because you're at or near retirement or already retired is a real problem.
That's fair. So yeah, get some professionals on your team, ask the questions, because you'd rather just pay a little bit for some expert advice than kind of have a long 20, 30 years ahead of you.
Or Google is not always 100% accurate. You know,
what do you mean?
so
Everything on the internet is true.
You're right. I'm sorry. Of course it is.
No, but you're right. Google, and it does not pertain to you. Everybody's situation is very unique. And so you do want to have a professional talk to you about your situation rather than just Google's vague understanding.
This is not your brother's divorce. This is not your friend's divorce. This is not anybody. This is mortgage and divorce are very unique to each person. So It is not always helpful to get input from everyone around you that doesn't have the exact same situation that you do.
Definitely. So I know our topic is, selling a home during divorce, but some people don't want to sell their home. They want to stay in their home. And so how can you know if you can afford to stay in your home?
So that's a great question that comes up quite often. Usually somebody wants to keep the marital home. Not right. Always, but a lot of times somebody wants to stay in that home. Usually it's where you've raised your family or where your kids come. So there's an emotional tie there. So the best way to know if you can stay in your house is truly to speak to a lender, and you really need to complete the application because that's the only way we can really know all of the details. We really need to see your credit. We need to see just the whole picture. But definitely a conversation is a great place to start. And a lot of times I'll help people structure their income also and maybe work with their financial advisor and say, this is the qualifying income that we need. Is this something that you can help us achieve so that we can refinance in whatever that time frame might be?
Yeah, because correct me if I'm wrong, but you want to refinance the home so it's strictly in your name, so you're not really tied together anymore. And so Correct. Sometimes people don't have that full income to take the full ownership of the house, plus Correct. House maintenance and all that extra taxes and things like that.
Yes. So that's why, well, you want to be untethered financially,
right.
Is really the end goal. But sometimes we'll be able to say, all right, we're going to be untethered, but we might need 6 months. We might need a year. So a perfect example is if someone is receiving support and we're using that support, it could be child support or alimony support. Everybody hates the word alimony. Spousal support. Then what we'll do is you have to have received it for 3 months in order to qualify for an FHA loan. Mm. 6 months for a conventional loan. So, and that money actually has to come directly to the other party. It can't be that you paid car payments or that you paid the mortgage. Those funds need to come directly to that party. And so once we've had it received for 6 months, you can close, or 3 months if it's FHA. So that's why timing is also important. A lot of times we'll write these agreements, and the intentions are good. The intentions are, I want to refinance in 2 months. Well, if we need the support to qualify, then that may or may not be allowable. Well, if we need the support to qualify 2 months, it's definitely not allowable. Or you may end up in an FHA loan and you don't need to be in an FHA loan. Maybe it's not the appropriate loan for you. So, waiting and having that language written properly can make a huge impact.
Yeah, those are important numbers to kind of know along your route, because it's not just like you're signed and it's done. You need some of that income for proof, and turns into a bigger thing, of course.
Well, and the other thing to think about too is sometimes you can qualify with an extra $50 a month in support. Or maybe the other party needs to pay $50 less a month in support. So if you're able to really get the full picture, then I can help advise how we can structure this agreement. I'm not saying we don't still divide everything 50-50 or we don't still make it equitable, but maybe one party gets more of an additional asset and then the other party pays more or less in support to make it even. But that way it's allowing them to actually do what they've said that they wanted to do, which was refinance, buy a new house, or whatever that might be.
Yeah. Interesting. Um, and so then some of these couples who have been together for a while have an investment property or a second home. Um, how do you kind of go about that? Do you just use it as like a typical regular home?
So there's some tax implications, particularly with an investment property, that you want to make sure that you are working through. And I don't want to get really in the weeds here, but you can do what's called a 1031 exchange. But that is kind of a complicated process, and you need to have that plan in place prior to closing. If you chose to sell that investment property, you need to have the plan in place prior to closing, because you have to have other parties involved. And it can be a huge taxable event if there's been a lot of capital gains on that property. So, second homes, sometimes one party wants to take the second home. That's okay. Where you want to come into really seeking extra advice is on investment properties in particular, because they've been generating income for you, and therefore they are subject to capital gains.
Ooh. Got it. So yeah, conversation, pre-planning.
Yes. And sometimes we're bringing in not just their financial advisor, but maybe their CPA or estate planner. I really like to bring in as many people as we need to get a clear picture so we don't have a huge financial surprise in the future.
That's a great thing to do, because we see these tax implications and how all these other things just kind of fall on top of one and another. So it all adds up.
Yes. And so for example, if you sold an investment property and maybe you didn't realize how large the tax implications were going to be, well, when you go to file taxes, who's responsible for that? How did you address it prior? What if you have a couple $100,000 surprise? I don't want that. Well, it never goes favorably, right? There's never like a favorable several $100,000 surprise in my experience. Usually it's in a payment form.
Right. But it's always something, as they say.
Yes.
And then I know the last kind of question we had is, can we use support as income to qualify for a mortgage? And we did kind of talk about that you are able to use that, but you want to still talk about that at the beginning.
Yes. And also keep in mind, we can do something that's called, because support is not taxable to the recipient any longer.
Oh.
So taxes are paid by whomever is paying the support. Whomever's receiving the support is not paying taxes on that. So sometimes we can do what's called grossing it up. And what that means is, because it's not taxable income, we can add, for the purposes of calculating in the mortgage math, we can add an additional percentage to that. So that makes that support actually worth more for the purposes of calculating what you're qualified for with a mortgage. Wow. So you can, when we're qualifying you, we can add currently, and again, all of this is a window in time, so these rules may be changing, but you can add an additional 25% sometimes to that amount. So if someone was getting $1,000, we may be able to say it's $1,250 a month in support, because as income, because it is support and it's not taxed to whomever is receiving it.
Interesting. So there are a lot.
It used to be the other way around.
Oh, okay. So there's a lot of little nuances that are continuously changing.
Yes.
And it could be a big gap between, getting a house or not getting a house, which, like you said before, it could be $50 or just some of this small percentage that does add up, which you need to know about.
Yes. And sometimes the way that the attorneys will structure it too, this is very common, is that a lot of the marital estate is in the property, is in the marital home. And right. So what they'll say is, we're going to do a cash out refinance. So we're going to take cash, we're going to refinance the house for more than what the current mortgage is to get cash back. Again, can you qualify for that extra cash? Maybe you can't. So we need to divide up maybe more retirement assets. Or the other thing I would also stress is credit scores. Mm-hmm. Have your credit score, not your credit card credit score, like an actual mortgage credit score pull. because again, if your credit score is below 580, you can't qualify most of the time. There are some programs where you can, but for the most part, if you've got a low credit score, that may prohibit you from qualifying, even if you have enough income.
Right, right. And that's something we do like to stress to, any woman who's thinking about getting divorced or is going through divorce, that you need to, get a credit card in your own name and work on improving your own credit score, because sometimes, they think it's merged and it's not. And so you've only been working on his credit score, not yours. So yours might be lower now, which again, when it comes to buying a home or even, sometimes renting a home, you need to show your credit score, and that's important.
The rental housing market has become much more stringent on credit scoring.
Yeah. So you want to make sure that you have your own credit score because it's not a shared asset.
That is correct. And I would also suggest locking your credit to make sure that nothing can be taken out, especially while you're going through the divorce process. Just make sure there's nobody. Well, you should do that anyway, but make sure that no additional credit's being taken out without you knowing, because you can lock it and then you would unfreeze it and you can refreeze it if you needed someone to pull it, and then you are aware of when it's being pulled.
So does that mean you can still use your credit card while it's locked?
Yes, you just can't get new credit without unlocking it. So you can go directly to the credit bureaus and ask them to freeze your credit. And then let's say that you froze your credit and then you want to apply. So you call me and I say, okay, tell me when your credit is unfrozen. We'll pull your credit and then you can refreeze it. And that prohibits somebody else from taking credit out in your name.
That's important, especially in a divorce.
Yes.
I'm sure you've seen some wild things.
Yes, we've seen some very interesting situations for sure.
Well, this has been a ton of great information about, thinking about buying or selling your home in a divorce and kind of why you'd want to talk to all these different professionals to make sure that everyone's working hand in hand, and the things that are written on the paper are being able to be executed and all those other things as well. So before we, log off today, are there any last tips, tricks, pieces of advice you want to make sure our audience hears today?
I would just say that if you are even considering a divorce, or maybe you got surprised that someone else is considering a divorce, before you start agreeing to anything at all, I would strongly recommend having a conversation with professionals that are well educated in this field. So not just your attorney, definitely speak to a lender. And the sooner you can have those conversations, even if you're getting bad news or seemingly bad news, we've got time. So if there are some things on your credit, maybe we can say, all right, in 6 months from now, you'll be ready to do the things that you wanted to do. Maybe it's a year from now. But I'm a big believer in a plan. I can handle anything with a plan. So I may not like the answer today, but if I can have a plan for where I'm going to be, then I'm okay.
Yeah. And some of those professionals, like you said, like you are CDFA, which is Certified Divorce Financial Analyst.
Yes.
There are some loan professionals who have a CDLP, which is a Certified Divorce Loan
Lending. I think it's lending professional.
Lending professional. Okay. And so there are, very specialized people in these different areas. So don't be afraid to ask about their expertise or what qualifications they do have in this divorce process. Because as you can see, there are these little nuances where you want someone who really knows their stuff.
Yes. Always seek advice. And I do that every day myself. I don't know anything about a lot of other things. So I'm calling somebody else to say, can you please give me some direction here?
Yep. And somebody just jumped in. That's a great takeaway. Make a plan so you can work towards a solution, which, yes, is essential. So thank you, Jamie, for coming on today. If anyone else has questions or wants to reach out to Jamie, her email has been going through the bottom, jamie@jamieminster.com. She's also one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co. And we will be back here again in 2 weeks with some more financial education to help you be financially fearless. So thank you again, Jamie, and we'll talk to everyone soon.
Great. Thank you for having me.
Yeah, bye.
Bye.